Welcome. On today's podcast, we will be talking about forces shaping the global energy landscape and what that means for investors. We'll discuss shifts that are underway in the energy sector, from record-setting renewables to rising demand for natural gas and the staying power of oil and offshore drilling. Joining me today is Jack Bocock. Jack's a portfolio manager on Pinnacle's small cap value team, who co-authored a new white paper titled Investing in the Energy Sector, Finding Opportunities in a Changing World. Hey, Jack.
Hello, Charlotte.
Let's delve right into what's driving energy markets and, more importantly, where investors should be looking for opportunity. First question, can you address some of the most important macro changes that you're seeing that may improve the energy sector's prospects?
Sure. Let me set the stage a little bit. First, it's important to remember the energy sector has been the worst sector in the market for basically the past decade. The sector is cyclical, it's hard to predict, and therefore it can be hard for buy and hold investors to invest in. Personally, we have learned the hard way not to depend on commodity price improvements when analyzing energy stocks. But things change, and investors are looking beyond a few large cap technology companies, and we suspect the energy sector can be more fruitful over the next decade than it was over the past one. With this in mind, we think there are two interesting themes for investors to look at. First, our power grid in the U.S. is underpowered and unreliable for high-end users like database centers for artificial intelligence. Second, oil and natural gas production in North America is getting harder and harder. The best plays are being exploited and production curves, decline curves are increasing. Therefore, U.S. producers are going to look offshore for new sources of production. We think these two developments are secular and can create opportunities for investors.
Interesting. All right. And how are you thinking about natural gas today, and what companies do you think are best positioned to benefit from that boom?
So natural gas prices are not booming, but we believe that natural gas is the fuel of choice for supplemental database power and also for international customers, both commercial and governments, looking for relatively clean, secure power. The companies that we think can benefit from increasing use of natural gas are Solaris Energy Infrastructure, Argan, and Golar LNG. Solaris, symbol SEI, provides mobile natural gas-fired turbines to database centers and other clients who require consistent electric power, better power than they're getting from the grid. SEI has just announced a joint venture with a large customer for 900 megawatts of turbine capacity and an initial term of 7 years. This is kind of the worst kept secret in the sector. We believe this customer is XAI, Elon Musk's artificial intelligence company, with a massive database in Memphis. SEI has more demand for this capacity than it can serve, and is negotiating, we believe, 3 to 4 year paybacks on the new equipment it is ordering. The stock has come down substantially, and we think it has excellent potential over the next several years. Argan is a very high quality engineering company that specializes in the design and construction of natural gas fired power plants. Argan's management are excellent operators and have a history of generating very high attractive gross margins, at times at double those of their competitors. Argan is a small cap stock, but it has got $300 million of unrestricted cash on the balance sheet and no debt. And finally, Golar LNG. Golar builds and runs floating liquefied natural gas platforms. These are basically ships that process natural gas into LNG. Golar signs very long-term contracts, think 10 to 20 years, and is at the beginning of a multi-year free cash flow generation cycle as these new contracts come online.
Let's switch gears now and talk about shale. We've seen a decade of growth from shale, but I understand that might be leveling off. Your paper highlights offshore oil as the likely next driver. Can you walk us through why that's happening and what companies stand to gain the most?
Sure. So as I mentioned earlier, the Permian Basin decline curves are increasing, which means it's harder and harder for the operators to keep their production flat, much less grow that production. And consequently, we believe that U.S. and international oil and gas producers will need to look offshore to replace their current production. With that in mind, we like Tidewater. Tidewater, symbol TDW, is a pioneer in the offshore supply vessel OSV industry and currently owns and operates the world's largest fleet of OSVs. A few points on Tidewater. Leading edge day rates are moving higher, and management has a positive long-term outlook for the next couple of years. The company produces strong free cash flow. They have been buying back stock, as have the insiders. This is an inexpensive stock at an attractive valuation, in our opinion, and it will be interesting to see how much stock they've repurchased in the first quarter, given the weakness in the sector.
Thanks. Another question, your paper states that we're not seeing a true energy transition, but instead an energy addition. Renewables are growing, but so is coal and oil. What does this mean for long-term investors who are trying to navigate decarbonization goals with economic realities?
So the concept of energy addition, I have to admit, this concept is not mine, but I think it's important to understand. So I want to read an excerpt from an article by Dan Yergin and Peter Orzog and Atul Arya in Foreign Affairs called The Troubled Energy Transition. In 2024, global production of wind and solar energy reached record levels that would have seemed unthinkable not long before. Yet 2024 was a record year in another regard as well. The amount of energy derived from oil and coal hit all-time highs. In other words, what has been unfolding is not so much an energy transition as an energy addition. Rather than replacing conventional energy sources, the growth of renewables is coming on top of that of conventional sources. So long story short, we do not think carbon-based fuels are disappearing, and we think there are opportunities in the transition.
Okay. Interesting. Your paper also spotlights some interesting infrastructure plays, including companies involved in building natural gas-fired turbines and grid expansions. Can you tell us more about what makes that area compelling?
Sure. So another company we like is Quanta Services, symbol PWR. Just reported earnings yesterday, I believe, and the stock had quite a good day. Quanta is an infrastructure company focused on the U.S. power grid. We believe we're entering a multi-decade cycle of energy infrastructure repair, upgrade, and growth, and all of that plays into Quanta's business plan. This is a very high-quality company with a multi-year backlog of work. Quanta has a history of annual dividend increases and consistent free cash flow generation. And finally, BWX Technologies, symbol BWXT. This is another interesting infrastructure-related company. BWX has a steady recurring nuclear fuel equipment and services business, and this includes modular nuclear reactors, which we consider alternative power, and also a military business that is mostly recurring nuclear submarine equipment, as far as we know, and BWXT is the sole source for some of that equipment. Both of these are steady businesses generating nice free cash flow with very high barriers to entry.
Great. What risks should energy investors be thinking about right now?
Well, oil and natural gas prices are relatively weak and could weaken further if the U.S. or the worldwide economy slips into recession. And if that comes to fruition, it'll be hard for the energy sector to outperform with weak commodity prices. And finally, the energy sector is still cyclical. Argan and SEI have more secular growth prospects than most, but Tidewater in particular can be highly cyclical, so we need to be sure we don't fall in love with that stock if it really begins to work. We think the stock has quite a long way to go, but it's not really a long-term growth story.
Great. All right. Well, thank you for joining us, Jack, and for offering such a thoughtful perspective on where the energy sector is headed. For our listeners who want to learn more, please check out the white paper on Pinnacle Associates' website. It's called Investing in the Energy Sector, Finding Opportunities in a Changing World. And you can also reach out to Andrew Aras at aeras@pinnacle-associates.com. Thanks again, Jack, and have a great rest of your day.
You too, Charlotte. Thank you.
Thank you.